Stocks on Wall Street initially extending their gains Wednesday after the Federal Reserve decided to stand pat on interest rates. For analysis, we turn to Kristina Hooper, Chief Global Market Strategist at Invesco. Welcome back, Kristina. So the Fed, basically citing moderate growth and a strong job market, decided to hold rates steady. What's your assessment of their decision today?
Well, I think it's as expected. The Fed is clearly on top of the economy, but it's also recognizing that where it is, the 3 insurance cuts that it made in 2019 have taken rates to a place where it's very comfortable sitting for a long time. So even minor changes in the economy, for example, we noted that household spending went from strong in the last announcement to moderate in this announcement, are okay. They can certainly tolerate that and maintain rates at a current level, and I think they expect to see rates stay at that level for some time to come.
But Kristina, is it not a concern when they say that household spending, i.e. consumers, are moderate now as opposed to strong when consumer spending is what has been driving the economy at a time when business spending has been weak?
Fred, you raise a great point. It certainly is a yellow flag. We want to pay very, very close attention to the health of the consumer. And that starts, of course, with the job market and with leading indicators about the job market. So not so much the unemployment rate, but more metrics like initial jobless claims. But it is absolutely critical that the consumer is healthy because, as you rightly point out, that is really the foundation of the U.S. economy.
And how concerned at this point, although it wasn't explicitly stated in the statement about the coronavirus, later on in the news conference, Fed Chair Powell did say that he was concerned about it. How concerned should investors be at this point in judging the impact of a coronavirus versus, say, what we had years ago with SARS?
Well, I don't think investors should be that much more concerned than SARS. I mean, we can only use recent epidemics, recent contagions as a guide. And SARS certainly did have an impact on certain economies, not so much on the global economy, but we certainly saw an impact that was quite significant on the Hong Kong economy, on the Chinese economy. But in the grand scheme of things, it was pretty short-lived, and there was some level of bounce back. I actually think this time around, it's better for a few different reasons. First of all, of course, China has been far more proactive and transparent. But secondly, and more importantly, what came right before the emergence of the coronavirus was the signing of the Phase 1 trade deal between the U.S. and China. And we were noting that there was a lot of improved sentiment for both consumers and business leaders in China as a result of the signing of that deal. So that doesn't go away because of the coronavirus. It's just held in abeyance. But once the coronavirus is in fact contained, stabilized, that's when we're likely to see a resurgence in spending. And I think it will actually be bigger than what we saw before the crisis simply because of the U.S.-China Phase 1 trade deal.
And any advice for investors in terms of the coronavirus?
Well, for those with longer time horizons, there really is nothing to worry about. We've seen this before, and we recognize that there can be some short-term headwinds, but ultimately it really won't have a significant impact. But having said that, there may be those who would like to think of this as an opportunity. And in fact, there are some exciting opportunities that I think are being presented by this coronavirus, in particular Chinese equities. This is a year in which I expect Chinese stocks to outperform quite significantly. We've really seen that begin in the fourth quarter of 2019. I expect that trend to continue, although we'll see a hiccup between now and then as a result of the coronavirus. That should be a buying opportunity for those who are under-allocated there.
And lastly, Kristina, going back to the Fed decision today, the guidance on the Fed in terms of when it'll stop its Treasury bill buying operation, April is given. What's your assessment of that? How and when should the Fed actually stop?
Well, it's difficult to say, but I do believe that relying on a few large banks to essentially make a market can be problematic. So I wouldn't be opposed to the Fed having a standing repo facility, and that may ultimately be the solution the Fed arrives at.
A standing repo facility as opposed to just cutting it all off.
Exactly.
All right, thanks a lot, Kristina, for your thoughts. Our thanks to Kristina Hooper, Chief Global Market Strategist at Invesco. I'm Fred Kantayama, and this is Reuters.